All right, I think we are live and we are good to go. Hello, everybody, and welcome to this week's edition of Selfwealth Live, the technical analysis edition. Here from the office. It's very rare that I'm in the office on a Tuesdays, but I am actually physically in the office today, which is a nice change. And as you probably see, I'm in a nicer shirt. So, but it's not. I don't have it painting just yet. Sorry, I don't have any painting behind the office here. So. Unfortunately, we need to work at the artwork here in the office as well. Anyway, welcome to you, Jason. How are you today?
Hey, Roger, I'm good. I'm good. Had an enjoyable Easter and looking at the markets on the end of last week, coming into this week, interesting things there. So, yeah, all in all pretty good.
Good. I know you had an interesting Easter, and we'll touch on that very soon as well. And I hope everyone else had a nice Easter period as well, Easter long week end, and celebrated with family and whatever it is. And even if you don't celebrate, I hope you had a nice weekend either way. Just before we get going today, just to preface that we are going to be sticking to a 1 hour show today. Just for today, obviously we might be able to go overtime. We've always been going overtime a little bit just to make sure we try and get onto everyone's tickers. But for today only, we've got to stick to 1 hour. So whilst I'll try and get onto everyone's tickers, hopefully you send them through. Obviously, we are going to stick to that 1 hour today. All right. So I'll probably stop taking tickers around that 20 to 1 mark. All right. So, yeah. But let's get going. So welcome to everyone else on the other end of the line and the show here. Let's start off. Before we get going into the action, let's start off with a disclaimer, please. Thanks, Jace.
Yes, of course. Every day, as every other week, is general commentary only, no personal advice. And I'm quickly going to put on the disclaimer that we do each week. And this just goes through that. I'm also not part of Selfwealth. My business is Motion Trader. So you'll see my details at the top with licensing and all of that. And beneath there is Selfwealth. So, yeah, general commentary. And that's our general disclaimer.
Fantastic. Thanks, Jace. All right. So before we get into the markets and everyone's ticker, I just wanted to touch upon the parallels. And I think this is really interesting, to be honest. First of all, we've got to congratulate Jason because he went to a bit of a Masters race meet down in Adelaide on the weekend and achieved some amazing results in his chosen field of athleticism. All right. So not only is he a great active investor, as we all know, and we learn off him and all that sort of stuff, but there's some great parallels with what he can teach when it comes to athletics and relating that to trading as well, right? So first of all, Jace, I know you won, or you got silver in the 800 meter run, right? And then you got gold in the steeplechase. Is that right?
Yeah,
Right?
that's right. So we had the National Masters Athletics in Adelaide over the long weekend, and yes, it's something I do. I prepare quite a bit for it, and yeah, it's good fun. I like running. I like competing, racing against my own age group. It's one of the great things of Masters competition, be it athletics or swimming or many other sports. And yeah, so the 800 metres is one of my specialties. A 3,000 metre steeplechase is a bit of an adventure race. You're jumping over things and going through water, so it's all very interesting around the track. And yeah, look, it was good. It's interesting, Rog, because you did say there are parallels, and there are really interesting parallels between athletics and trading. At least they are for me. It's so I had a good result this time around. But I remember last time I went to Adelaide, it was about 8 years ago, when the Masters does the circuit around the country. It was down in Adelaide about 8 years ago. And I was running in the 1500 that year. And I had two goals. One was time-based, one was position-based, and I missed both of them. I came fifth by about a second, missed some medals, missed my time. And I was talking to a coach after the race, and he said, I was pretty disappointed. And he said, look, Jason, we get more practice at losing than we do at winning. So we've got to get good at losing. And it's so true. And this is where it really applies to trading and investing, because we get more practice at losing trades. Most of the stocks we buy don't perform. That's how the stock market tends to work. So we've got to get good at how we manage losses. And a lot of people aren't very good at handling losses at all. They do things that often don't work, like doubling up and refusing to sell and being stubborn. All these things can work poorly in an investment context. So for me, getting good at losing, it's in training, it's about in running, it's about bouncing back and focusing on your plan. Everything's plan based, everything's systematic, be it running or trading or whatever else. Focusing back in on the strategy and going. And when you come to trading, it's the same. It's follow the plan, stick to the script, keep it systematic, keep the emotions out of it. Get out when things aren't working. You get out. You take you retreat, you regroup, and you come back, and you be persistent with your ability to take trades and cut them, rather than being persistent with hanging on to things which aren't working. Very big distinction in how we use persistence. Persisting with losing trades, disastrous. Persisting with a good strategy through difficult times, that's what leads to strong results over the years and longevity in the game.
Yeah, 100%. And I think one of those things that I wanted to touch upon is, if we look at the times that we're in with the markets at the moment, how can we relate that to yourself and the training you've had being an athlete, and not being able to get the results you want, but being able to continue moving forward, knowing that you would get those results eventually down the track. Have you as an athlete, or has someone who's been able to train themselves that way, has it helped you with your investing as well, trading and investing? Because obviously this can relate to just general exercise as well. You don't need to be an athlete, but just general exercise, how can that help you, in your investing and trading as well?
I think the overarching commonality here is it's discipline and systematic. So, and then that branches down into both fields, be it in the markets or be it on the athletics track. It's having the discipline to, well, firstly, it's about having a process, whether it be a training process or a trading process, and then having the discipline to stick to that process. So if you want to be an athlete and you just go out, you wake up, okay, look, I'll just go for a run up the hill today and I'll run around the block tomorrow. It's not really systematic. It's a bit ad hoc, and your outcomes are going to be a bit ad hoc as well. And whereas, and the same applies to trading. If you just go say, look, I heard a good news report about this stock, so I'll buy a bit of that, and this one's not going so well, but I think it can come good, so I might average down. It's not really planned. It's a bit scattery, and so that's how you get mediocre outcomes, by having mediocre planning. So that I think that's the key to both. It's like having and anything else. It's not just running. It's not just trading, but anything you do in life. I think if you've got a good plan, and then you've got the discipline to implement it the way you've intended and the way you've researched it, right? I think that's where you get the outcomes. But all too often, emotion can come in and derail a good plan, because we just lose our confidence, and that's where, for me, it's back testing. I can back test a strategy. I can see it's worked over 30, 40 years, and I go, okay, look, I've got confidence. I know it won't work year in, year out, but I've got confidence that over time it plays out. So then I've got the ability to stick with it during the difficult times. Like now's a difficult time, and then there are difficult times where the market goes down for 11 out of 12 months. That I've experienced that before. That's where you've got to have the confidence in your process to stick with it, to hold the line when things are difficult, and bounce back and stay in the game.
Yeah, all right, fantastic. I think that's a good little intro, I think, for today, and just to obviously congratulate you on your efforts outside of investing and trading. It does come down to planning a process, having having the discipline to sticking to the process, and the results would be the results. But if you, like in anything, like I said in life, if you don't do that at the start, and not having the discipline to do it, then the results will always be mediocre, if there's any results at all, right? So I think that's a good point to stick on. All right, let's get on to one question here, Jace. Do they drug test the masters? Do you get drug tested, mate?
No, I think the focus is on the youngsters. But it's interesting though, when you get to like a world Masters event, some of the performances are just outstanding. So I don't know. I don't know. Maybe they. I don't think they do, but it's like, yeah, it's people take these things seriously. There's people who go along for fun and social, and it's being around like-minded people. But yeah, at the where it really gets to the fast end performances, it's some of these athletes are amazing, and it's a good question. I actually don't know, but yeah.
Well, we won't ask you then, Jace. It's all good. Well, look, I think the fact is that you're doing that outside of investing and trading shows to me that I have the confidence to be able to listen to someone like yourself and really take that on board, right? Because not a lot of people are able to do those things, right? So, and stick. Right on there, mate. Let's get on to, before we get on to some tickers, please send through your tickers. Let's get on to this after the long weekend. Not much happened, but let's have a look.
Okay, so starting off with the ASX 200. So after a couple of weeks of extreme volatility, the ASX has been more subdued in recent days, and it's interesting to see the ASX 200 has been holding up pretty well after a couple of days of lower levels in the US. Just looking at where prices are now, they're trading up near their highs for the day. So the ASX 200 didn't see Monday's price action in the US. So we're closed for Monday, but the US isn't closed for Easter Monday. So there's been a couple of down days, and market's trading well. So that's encouraging. But I think the key feature to recognise here is that there has been an important structural shift. So we no longer have a market that's trading above rising moving averages, which was the case throughout most of last year. It's now a case that the market is below these declining moving averages. So I'm using the 50 and the 100-day moving averages, and this creates an inherent vulnerability to the situation. And it's a setting that I think a lot of people don't fully appreciate. And that is, rather than buying the dip back to a rising moving average, when you have declining averages, there's a tendency for the focus to shift to selling the rallies. And we saw a bit of that towards the end of March. We rallied back towards the moving averages, and then it was sold off. Now, at some point, of course, there'll be a final low, and that final low will be below the moving averages, and that's a dip we'd all like to buy. But how do you distinguish between a temporary low and what could be the real thing? And the answer is you can't. You can't really separate them until you look back with hindsight. So, for instance, will the ultimate low in the current market, will it be like a COVID style low where the market came down and quickly rebounded and started going up? Or is the low we currently have, is it more like a first round low like we saw in January 22? Or is it a second round low like we saw in June 2022? And at the point of those lows, you don't know. You just don't know which one that you're dealing with. Nobody knows. So we can speculate as to whether the low's in or not, but there's just no way to tell. We can look at things like oversold readings, sentiment indicators, value indicators, and all these things can help identify when a sell-off is overextended, particularly things like sentiment and some of those oversold readings that we look at. They can be really helpful in identifying potential areas for lows to form, and very much did that 2 weeks ago. And also at we're talking about extreme readings in early April and early to mid March, and we got rebounds, but they don't tell you that the actual low is in. We only know that, as I say, with hindsight. So while prices remain below these declining moving averages, I think it's a case of playing it defensively until the chart action flips again and we find ourselves back on the good side of the averages. following a strong rebound. So we've had this strong rebound off the 7th of April low, strong rebound. So following a strong rebound, it's pretty typical to get some sort of a consolidation, and that appears to be what's happening now. I think the key here is that what we want to see, I think the key to what we want to see now is any weakness quickly finding support and attracting buyers. And I think this will be the gauge to the underlying strength of the market. And so far, it's encouraging. We've had a strong rally, initial pullback, another rally, and now it's holding on to the gains from the low last on Thursday the 10th. It's holding on to that was a week and a half ago. So it's holding on to those gains really well over the last 5 or so sessions. So I think that's an encouraging sign. If the ASX 200 can hold on to most of this recent rally, well, then it's a sign that the buyers are eager to accumulate on the weakness, and maybe it's a sign that the worst has passed. Jumping over to the equal weight, so that was the ASX 200 on a market capitalisation basis, so the biggest stock has the most influence. Coming over to an equal weight basis where all 200 are ranked equally, I think this helps. I think the equal weight helps understand the market's current structure. So like the ASX 200, it's trading below these declining moving averages, and it's also below this technically important region around 1,840. Let me just compress that. And you can see there's the pre-COVID peak. There's some technical activity through here in 2021, again some activity through 2022, and then we've got these previous tops in 2023. Into last year, there's more activity. And what we've got the sharp decline from a couple of weeks ago, and the rebound has come right back to this level, which has had all this technical activity. As I was saying with the ASX 200, what does the next pullback look like? So if the equal weight, if it continues to pause around this area of resistance, which is a normal place for it to pause, if we do see some sort of pullback, is it able to hold on to most of its gains? And if it can consolidate beneath this resistance, hold on to most of its gains, and then break back above this 1,840 region, then I think the odds start to increase that the sell-off from a couple of weeks ago was in fact a panic-driven event and not a larger bearish turn. So as I say, I think it's too early to tell. We're still looking at the price action, still watching how prices react to what continues to be an evolving situation. But we've got some markers to look for. First is, can we consolidate and get back above resistance? That'd be a good sign. So it's a case of watching this at the moment. But this isn't something that I want to aggressively preempt. I think the fact is that this remains a vulnerable structure, as I was discussing with those moving averages, and I think the downside risk remains elevated. So I'm not doing much at the moment. I bought a resource stock last week that triggered a buy signal, but that's about it. I'm still holding stocks. I'm still using wide trailing stops to try and see off what could be a panic-driven event. So I've still got a good half a dozen stocks which are up over 100%, which I've been able to ride through this pullback so far. Time will tell whether I can continue to ride through it. But the wide trailing stops, they're good at like giving a stock every chance. And I'm happy doing that, happy holding long positions still. But I'm also happy holding some extra cash because as I said earlier, we're not traveling above rising moving averages. This isn't the sort of conditions which these aren't bullish conditions. Maybe they re-emerge into a bullish setup later on, but at the moment, I think it's, as I say, defensive and cautious.
It's good to have a level to be monitoring at least to see if it breaks above. But I guess you're probably still waiting for a double confirmation for it to go above the EMAs as well, right? Wrong?
Yeah. I want to see like we saw last October 2023. Prices rallied sharply to the moving averages. That was good. They consolidated, then they punched through, so everything started looking better. And then we get the cross, and then we start getting the trending above the moving averages. So there's stages, and each stage things start to the odds start to tilt back towards the bullish side. But the ultimate, I think, the ultimate condition for bullishness is when we have price consistently rising above rising moving averages, and that'll take a bit of time. So getting up through this technically active region, that'd be I think that would break the I think that'd be a good sign that the sell cycle has been neutralized for now, but that doesn't in turn signal that it's a new bull market. It just says, okay, things have stabilized. There is buying coming back in, which is all positive, but we still want to see the price action flip to the other side of the moving averages, and the moving averages start to round higher. And that's going to take a little bit of time. It's not going to happen this week or next week. It takes a bit of time for those 50 and 100-day moving average to swing around.
Of course. All right, let's have a look at the US markets then.
So we've got the rally, and now we're getting the pull. And like we were talking about with the ASX 200, does this pullback get bought in the process of distribution where the price continues to slide? What I'm looking for. So just go back. I'm going to show you this example from the COVID period. Let me I was using these markers for something else. I'm just going to quickly take them off. If I can actually click on them, there we go. So they're gone. So what I'm looking for, so we've got that strong rebound off the low. So this is how it played out in COVID. Had the strong rebound, then we had the pullback, and the pullback held on to most of the gains. And that pullback was bought, and then prices then moved off to a new post crash high. So do we see? Is that the type of price action that we see in current times? Or a more bearish scenario would be like something that we saw back in 2008. So let me just go back to 2008. And in 2008, it was a case of there's a strong rally, but then that rally was sold into. It depends which one we could use. There's several strong rallies which got sold during that period, but you get like let's use this one here. We got like an aggressive sell off that looks more like what we've just experienced. Then we got that sharp pullback or sharp rebound, but rather than a pullback holding onto most of its gains.
I think we've just lost Jason, but see how we go here. Jace, are you there, or is it just me? Sorry, everyone. Jason, you back?
Still here, Rog. I know.
Right.
Just flip. There we go. We've got our charts back too.
Yeah, I've switched them all on. All good. Good to go. Keep on going.
Okay.
Sorry.
Well, let's keep rolling. So so they're the two sort of things we're looking for. Is it like is the market able to hold on to the gains we've got, or does it start, or do we get this like slippery slope where it's the selling's coming in as prices get back towards the moving averages? So this period that we're currently in is going to have its own unique price action. It's not going to be either the COVID period or the 2008 period. They're just sort of examples where we can see the dip being bought or the rally being sold. And but they're the type of patterns to look for. Is the pullback attracting buyers, or do sellers still have more stock to unload that pushes prices to lower levels? I don't know which way this goes. I think it's too early to tell. But below the moving averages is where there's a greater potential for conditions to worsen. So as I said with the ASX, it's just being defensive. It's being cautious, not being bearish. It's not about a sell everything moment, but it's about having more caution about entering stocks and managing the portfolio. I want to show you a potential positive as an indicator. It's this one here. It's the percentage of S&P 500 stocks above their 100-day moving average. And it oscillates between a low level and a high level. And we can just compress this for a moment to get a higher level view. It goes back a long way. Goes back to 2010 or something. And you can see this oscillation between bullish and bearish phases, where when you get almost every stock's above their 100-day moving average, is typically where markets tend to get a bit tired and pull back. Opposite applies when prices are down at low levels. And recently it was at what I'd call washout levels. So where there's less than 10% of stocks, you can see this blue line, where less than 10% of stocks above their 100-day moving averages, it tends to be a washout type event. And what we have now is prices have reversed off that 10%. So it's currently got up to around 28%, currently at 18%. It's not uncommon to get a retest once prices break out. You can see it happened here. Prices got down to about 3%, rallied back to 20, back to 10, and then the low was in. Doesn't have to be a final low, but it could be a multi-month low or a notable low. But often you can see the rallies start from these lower levels. What I look for in this indicator is a move below 10% and then a break back above it. So you can see a move below 10% and then a break back above it. For me, the break back above 10% is the trigger. And I do that because oversold conditions can persist. If you just start buying when it hits 10%, you can get stuck in a continuing downtrend. Doesn't mean the market has to snap back straight away. You can get oversold conditions can persist. So what we've got with the current situation is we've been below 10, we've broken back above it. So that's a trigger to at least just be watching the market for those signs that we're talking about, like can prices get above resistance, can it get back above the moving averages. So this is the sort of conditions where a low can form. This is only one indicator. I think it should be used in conjunction with what we're seeing in the price action. At the moment, we've got that pullback. So I don't want to go in and be buying a pullback below moving averages. I think there's a bit of risk with that. But if the pullback finds support, there's buying interest and prices start to push back above the highs that we had last week, well, then maybe it's the time to consider maybe averaging into some index ETF, for instance. I'd still be cautious on individual stocks, but index ETFs as a longer term strategy can sometimes be a bit of a play. Coming back to the S&P 500, I don't want to stay defensive for longer than necessary, but for now, I think this structure warrants caution. Yes, lows form in this type of environment, which I was just showing you with the that indicator, but it's still no sure thing, and it doesn't necessarily mean there's going to be a quick return to all-time highs. You can get a situation where a low could be in, but then there can be messy price action for several months. So I think the play here is just keeping risk at lower levels, and until we get more clarity on the price action, and we get prices above moving averages, which start to turn higher. At the moment, that's clearly not the setup that we have.
Okay, still got to be patient around all this. So let's have a look at the Hong Kong market then.
Not much change from last week. We're seeing that rebound continue, but with prices below these moving averages, which are declining, a lot of technical damage done in that sell-off. I don't think there's a hurry to do a lot. I think it probably takes time for this to repair. It's look, I think this is just a no-go zone at the moment. Same goes for the Chinese market. It's rebounded off the lows, but the rebound really has prices just butting up against resistance. You can see this series of lows through there. It's getting through there, but then it continues continues up. We've just got this, this cluster of price action around where prices are sort of like butting up against now. Also coincides with the moving averages. I just think the upside potential doesn't justify the risk at this point. Yeah, it might continue to grind higher, but it's like at best it's within this big sideways pattern still that's persisted for the last 6 months now. So for the moment, I'd just stand aside.
Very good. All right, let's move on to some general questions quickly. This first one's from Robert Jason. The stocks get on my radar. I buy it, and in the next couple of weeks, there is a capital raise at a much lower price. What would you do? Buy a new allocation or do nothing? Move stops.
Yeah, it's frustrating when that happens. If the allocation is below the current price, I typically don't participate. What I tend to do with those things, I'll wait until the closing date and see where the price is relative to the price I can invest at. So if the market price is like, let's get a stock. I'm just getting a stock which I know had a tumble the other day. It wasn't due to a capital raising, but this is often how a capital raising looks like. So say the company, and again, this is not a capital raising. This is due to an announcement about a mine expansion or something. So the company will say, okay, we're raising capital at $2. The price is currently $2.80, and we're raising it at $2.20. So the price gap's lower, and it's frustrating if you bought into the uptrend, but it does happen. I'll wait until the closing date. So say the closing date is a month later. Price is now $2.40. I can buy stock at $2.20. Well, then I might buy some. I probably would. If I've got 10% or so of upside through taking a stake at a good level, or a level which is better than current market price, I'd do so. But if the price is trading at or below, if the price I can buy them at is above the current market price, well, I don't want to buy them through the issue, because I can buy them on market at a lower level. It's a difficult situation for a lot of people to decide what to do there. I'd probably look at are we there? I thought I might have just dropped out again, Rog.
No, you're here with me. I can hear
Yeah.
you.
Oh, good. So I think it's a case of look at the price near the closing of the offer and decide, does it make sense to go ahead or not? I think that's probably the best we can do. But it's a frustrating situation, I know.
If it gaps down below your stop, what would you do?
I'd probably sell it.
But if you look at if you look at Ramulus here, it's kept on going up from that. If we were using that,
Yes.
right?
Again, this wasn't a capital raising. They announced they were going to do a mine expansion. I've got this stock myself, so I'm a little bit familiar with the situation. It was about, they announced that they're taking over a company. I think it might be Spartan Resources, perhaps. I'm not sure. They're taking over a company and they're doing an expansion. The market initially didn't like that and sold it off. So I held through this sell-off, and I'm still holding the shares now. So, but it didn't get down to where I'd have my stop loss, which would have been a bit lower. And also, it did seem like an overreaction. I've seen this before in gold stocks, where the gold company comes out and says, we're going to spend some money, and the market, for whatever reason, doesn't like it when gold stocks spend money, and they get sold off. And then I've seen them in the past come back, and sure enough, it's happened on this occasion too. But yeah, if a stock breaches a stop loss and it's a capital raising, I'd probably be inclined to close it out. I certainly wouldn't be looking to put more money into it. That's sort of like averaging down into a stock which has come back. It can be hard to do that, because it might seem like the company's in a strong position, but the market doesn't like it for whatever reason. I'd probably be inclined, if it's hit my exit, I've got to exit it.
Yep, stick to your rule, I guess, which is exactly what we were talking about right from the start as well, a little bit. All right, let's get on to some tickers. Starting with JPM from Jacques, please.
JPM. So this would be a US stock, would it? JP Morgan.
A couple of US. The next one's Nvidia as well. So.
Right. Okay. It's well, we've lost that nice structure. We've lost the bullish structure of a rising price above rising moving averages, just like we were talking about with the ASX. It's below the averages, which creates vulnerability. What has been somewhat encouraging is it's a snapback rally. It's like it lost a lot of ground, but then it's come roaring back. So that's positive. And at the moment, it's holding onto those gains quite well. If I was holding this and I was able to see off that initial decline, I'd continue holding it for now. If this decline didn't stop me out, my trailing stop was wide enough, I'd continue holding and see whether this is indeed short-term panic, because that's one of the possibilities we have with the market at the moment. This sell-off is short-term panic, not a longer-term bearish change in structure and decline. So I wouldn't buy it at this point. I'd want to see it get back above the moving averages to consider buying it, because it still could be an aggressive rally back to the averages, and then it starts to ease away. But I think whilst it holds the April low, I'd be inclined to give it the benefit of the doubt. But for buying, I think we want some more positive price action. I want to see it on the good side of the averages, holding onto those gains, and then starting to push higher, and then then it could become a buy.
All right, fantastic. We've got a couple of people asking for Nvidia.
I just don't like this price structure at all. We've got a series of lower lows. So this, like the JP Morgan price structure looked better. This one, it's more, we've got like several lows below moving averages, which are now declining. If I had it, well, I'd have a calculated stop loss. So I'd be working on the basis of that, which not quite sure where it would come in. But for me, this is certainly not a buy. I don't like this type of situation where we have price below the moving averages. I think it's in a vulnerable position. If it can hold the low from early April and not lose any more ground and start to stabilize and then break back above the averages, then the situation starts to improve. But as it stands, it's not a stock I'd be confident in certainly wouldn't be confident or comfortable in buying it. I don't want to try. That's just not what I do. I don't try and buy the lows. I prefer to buy a breakout to the top side, and we don't have that at the moment. And if I was long, I'd be very much thinking about, okay, where's my exit on this? How much room am I going to give this to the downside? It's like when Nvidia turns, like look at this decline back in 2021. Like that was 70%, about 70%. So when this stock turns and starts getting lower lows below declining moving averages, it really can wash out. And we saw another big sell event in 2018. So that's not to say it's going to do the same thing now, but it's just how things can get away when you have price action below declining moving averages. So what's that at the moment? That's 43%. So that would have triggered my wide trailing stop. I would have thought. That's what 70% looks like. 70%'s down here. Again, it's not to say that's going to happen. That's not a prediction. It's just looking at something that's happened in the past and saying, could it happen again? And I think we have to say, yes, it could happen again. So that's why I'm very focused on, I want to manage the risk of the situation. And it's not just hold and hope that it comes good. So, it's a stock I'm not comfortable with at this point.
All right. EOL, please. Put it back on the Aussie market.
Yeah, it's a great trend, this stock. It's a low liquidity stock. It's not a great deal of volume around it, but it's doing its own thing. It's got the rising moving averages. Prices have just been at a new that looks like a new all-time high. If I had this, I'd keep holding it. Wide trailing stop back below the 100-day moving average. I'm probably not too keen to buy it at the moment, just in this environment. Even though it's doing really well, it is getting a bit away from its moving averages. So I'm not sure it's the best buying point, but I'm certainly happy hanging on to it.
Okay, fantastic. Spot. Let's have a look at Spot if we can find it. Spotify. I'm sure we all listen to it.
Yeah, and it's holding up fairly well through the volatility we've seen. It's been a great trend. Like, look at that. That's a lovely trend. Like, bought the break above the moving averages, had you used like a motion trader type strategy here, like wait for the moving averages to cross, and then buy a break to a new high. This has been a very tradable trend. Like, even this pullback here, wide trailing stop could have seen that off, and we go along. It's been well behaved back to the 100-day moving average and the 50-day moving average a few times, but that's normal. And again, survivable pullback. And so far, I think a wide trailing stop could have got this entire move and still be in it. I'd be watching watch that low from 7 April, break below there. It starts to then we start getting a series of lower lows, and the structure really starts to quickly weaken. At the moment, we could call this just a sideways consolidation, but I think we really want to see it hold within the current boundaries. The 7 April low, and then a break above probably the 25 March high could almost be enough to say, okay, it's breaking to the top side. I don't think that's going to happen in the next few days, just with the volatility happening. But if the S&P 500 stabilises and starts to maybe get more of a look of that COVID low to it, well, then maybe a stock like this could break to the top side. So I'd very much want to be holding it if I had it. And if I was interested in it, I'd be waiting and watching and looking to buy a breakout to the top side rather than just buying it in the middle of the range, whilst we do have this heightened risk within the market.
Yeah. All right. JHX.
Oh, I've got the wrong one. I've got the US listing there. Yeah, well, I'd be out of this one. This was a motion trader stock at some point, but I know it left the portfolio quite a while ago. Look, I don't. There's nothing in this for me now. It's fallen too far from where, like, yeah, we could have had a buy signal on this one back in September as prices got back above the averages, started to break higher, but that doesn't mean we're going to continue seeing momentum. Sometimes these breakouts, they fail and prices come back, and the idea is when they do, and when you get the sharp decline, they hit your stop and you exit them. You don't hold in there hoping for them to come back. This could come back, but I don't know if or when. It could take a while. Like, look at this period during 2022 into 23. It's the initial decline turned into something which was quite lengthy. It's certainly not a buy. It does look like it is quite stretched below the moving averages. So if I was holding at this very point in time, I'd probably use the low from the 4th of April as my stop now, and say, look, okay, there's my line in the sand below this low from a couple of weeks ago. If I can hold that, I can see if it can rally back towards the 50-day moving average. Maybe I can get out at a better price. but I don't want to hold it open-ended. It's like, who knows what's going to happen here. It's a weak structure. It's not the sort of stock which would have a place in my portfolio.
All right, fantastic. Jennifer congratulates you on your efforts, and thanks for always the compliments there, Jen. We've gone to Darwin, DRO. Darwin's giving us a DRO.
Drone Shield. So where are we this week with Drone Shield, which has been having a resurgence, and that continues. So this is pretty close to a buy signal for me. So the moving averages have turned higher in early March, or late March, I should say, and price is now making a new high. So for me, that would just about be a buy signal, assuming it's within the bounds of a volatility measure, which I use, which it may not be because it is moving around quite a bit, but it meets the basic structure of positive moving averages and price high. So this is one to consider. The issue with it is like where you place your stop loss, because it's got to be pretty wide to get back below the 100-day moving average, unless you just say, look, I'll give it 25% back to the 50-day moving average, and that's probably reasonable. If it runs, great. If it comes back, I might get stopped out, and it could still just be within a range, being messy. But to have a wider stop, like, then are you comfortable with 30 or 35% for your initial stop? It starts getting considerable, and then you say, well, to have 3-to-1 risk reward, if I'm risking 35%, well, I kind of need, can it get to 100%? Can I get 100% gain? I guess that's possible, but yeah, it's depends how much risk someone wants to take on. I think there's potential here. It's just managing that risk. How much you're willing to put on the line to have a go at getting on another upward swing and Drone Shield. I think the potential's there. It's just got to think about the risk.
All right, I'll do 2 per person, see if we can get through them. So SRG.
This has been a motion trader stock. I think it's probably still. Is it still in the portfolio? It may or may not be. I don't remember. There's motion trader covers the entire market, so I don't remember every stock. It's possible it's just held above its trailing stop, in which case I'd be holding it. I wouldn't be buying it because the moving averages have started to cross, and we've been below. We're just about on the averages at the moment. If I was holding it, I'd probably give it the benefit of the doubt. If it hadn't triggered my trailing stop, I'd give it the benefit of the doubt. I think, again, I'll probably say this a bit today, this is a key level, the low from 7th of April. If that low can hold, I think there's the potential to build upon that. But if it gives way, well, then I think we're into a larger sell cycle, and that probably applies to a lot of the stocks that we talk about today. But at the moment, I'd maybe give it the benefit of the doubt, but I'm not a buyer.
Okay. MQG, sorry, MQG.
Yeah, we talked about this one last week, and it's really stretched below the averages. So, like a snapback rally is entirely possible, but I don't want to trade something on the basis of a snapback rally. I want to trade it on the basis of a potential uptrend, and with the technical structure being as it is, it's not a stock I'd want to buy. So again, this is a pass for me at the moment. If I want to try and average into the market at lower levels, I want to do it through an ETF structure, like an ASX 200 ETF, not an individual stock. Too many things can go wrong with individual stocks. So yeah, that's how I'd play it if I wanted to try and get in at lower levels and trade this on the basis of this being a panic-driven event, which is going to be shorter term. I'd be going through an ASX 200 ETF, not an individual stock.
Mm-hmm. All right, BSL, please, from Alexandra. We've got this overhead resistance. I think,
Look, I don't think I'd be out of this stock if I'd bought that initial breakout. It's now come back to an extent which I think would have triggered my initial stop loss below the moving averages. I'd probably just want to clear this one. I'd probably use the rebound as a better exit point and just clear this one from the portfolio and just de-risk my portfolio a bit. So I want to keep holding the stocks which are in clear uptrends. And yes, it had pullbacks, but you can see the upward trend is still in place because maybe I've got a situation like, maybe I've got stocks in a situation like, it's not the best example. Maybe there's stocks like this where we've had nice rallies, it's pulled back to rising moving averages. I want to give them plenty of room to move. I want to keep them in my portfolio. But if I'm looking to de-risk and just move a bit of extra money into cash, well, it's going to be these ones here that I'll clear out. And because they're not in dominant trends, they're in sideways patterns at most, but they're at risk because they're below moving averages, which are flipping. So this would be one I'd probably be steering clear of.
Okay, the next one is IKE.
Thinly traded stock, but it's held up to the volatility really, really well. It's back to the moving averages. If I had it, I'd be keeping it. Wide trailing stop. If I really liked it, I could consider buying it. I'm not keen to buy too much at all at the moment, but if I'm going to buy a dip, that's a reasonable dip. Only problem is because it's thinly traded, and if it quickly loses its footing, it could be trading down at 59 cents with not many bids on the table. So I'd be pretty careful with it at the moment. I'd probably rather, if I was going to buy it, I'd probably rather buy a break to 80 cents. I'd rather pay a bit more and get it on an uplift than try and pick it on the downswing at this point in time. But if I had it, I'd be happy to hold it wide stop.
All right, next one's from Trent. TBR, please.
And I think this is a resource stock, which I think I bought last week. And I bought it because we've got these rising moving averages. It looks like it's been in a consolidation phase, and it looks to be getting some activity to the upside. So this isn't a special situation by any stretch, but I have noticed that a lot of the upside in the market in recent times has been in resource-orientated stocks. Maybe ones with a focus on gold in particular, but resources generally have been doing, like BHP and Rios haven't been doing so well, but a lot of those small to mid tiers, there has been some interesting plays. So I bought this on the basis that I think the sensitivity to some of these resource stocks is on the upside. So I've got this. I'm happy to hold it. I bought it around current levels. Exit strategy would be. We'll look at least below below these previous lows from a few weeks ago, below the 100-day moving average, below the previous lows, and see if this rally can take. If it takes, great. If it doesn't, well, it's a relatively small loss. Cut it, move on, and just wait for better opportunities to emerge. But at the moment, for me, it's a one to keep.
Okay, FWD.
Uptrend remains in place. I'd be holding it. If I had it, I'd be holding it. It's held up really well through the volatility. I don't think there's a hurry to buy it in the current environment, but it's it's been a relatively strong stock, and it's been compared to where the market bottom. That was probably there's the market low on the 7th of April. It's recovered all of those losses and made a new high. Yes, it's pulled back a bit, but it's generally got that strong price action. So I don't see a reason why I'd want to be cutting it. If you like it, really like it, I guess you could consider buying it. People consider buying it at current levels with a stop back below the April low, back below the 100-day moving average. I don't think it's a standout, but it's certainly a strong hold.
Okay, SSM. We've got a few to get through, Jason. We've got 5 minutes remaining. Sorry to remind you, push.
It looks like it's on the verge of breaking higher. It's had the sell-off. The sell-off was quickly bought, rallying off the moving averages. I've got this one. I'm holding it. This is why I use wide trailing stops. So all that selling we saw in the last few weeks, if you just saw the headlines and said, okay, I'm out, I'm selling everything, you sell stocks like this. There's no need to sell a stock like this because it's held above a wide trailing stop. So I want to sell what I have to sell, but I don't want to sell what isn't necessary. And at this point, this looks to me like the odds favourite is going to make new highs. So I want to hang on to it. I don't know that I'd want to be. It has had a big run. I'm pretty risk averse at the moment. If I was going to buy something, it's probably one of the ones I could consider, but I wouldn't be in a hurry to do a lot of buying.
All right, let's have a look at CGF. While you go to that, I'd like to hear the view of CGF, which rose 12% in 2 days, and RSI is in overbought. With the current volatility, do you still apply the wide stop loss strategy rather than taking profit?
Yeah, I only take profits when I've got an exceptional gain, might be 300% plus, and the stock's just getting a larger weighting in the portfolio. And a larger weighting in the portfolio means it can create more portfolio volatility when it swings around. So sometimes I might sell a third of a big gain, like I'm talking 300, 400, maybe 500%, not 100%. I'll just let the thing run. If I'd just recently bought some of this and I'd had a 20% gain, well, I'd be holding the whole thing. Wouldn't be interested. I wouldn't even be thinking about taking profit because that's not how I make my money. I make my money through big trends, not small swings. This has been a difficult stock. Like, look at this sideways price action over the last 4 years. It's been a nightmare stock. And we've seen this before. We've seen these strong moves that don't go anywhere. At the moment, for me, it's not a buy. It's above the moving average. The moving averages haven't crossed. I'd probably be waiting to see how does it hold. What happens during the next pullback? Can it, or the next consolidation? Does it hold on to most of its gains while the moving averages catch up? In which case, maybe it's a buy, or does it, as we've seen before, does it quickly give everything back? So I wouldn't be in a hurry to do too much at the moment in this stock. If I had some, I'd be holding it to see whether this is the one. Maybe this is the time it actually does run. But it's a funny stock. Of all the times it's had to run, it's moving now when the market is weak. So maybe it's a hold if I've got it, but it's not a buy here.
All right, we're going to finish off on this last one. There's a bit of banter around it. Pfizer. Let's have a look at Pfizer because there's a bit of fundamental talk around it. But
what's the code?
PFE, please. PFE. They'll talk around tariffs and the effects of it, but
this is terrible.
Yeah.
Like we should have been out of this stock, long ago. Like we could say, like, maybe there was a case. Like, if we looked at this in July last year, I would have said, look, there's a case to buy this. It's gone from below the moving averages to above. So all this time through here, just avoid. And if you had it, it's probably hit a stop loss somewhere, a trailing stop somewhere around September. And if you had bought this into this rally in December 22, well, then again, it's hit a trailing stop or an initial stop loss in February 23. Since then, it's just been a big avoid. If you'd bought this price action in July last year, again, it would have been an exit. And so it's given a couple of false breaks. False break in Deck 22, false break in July 24, but it's not giving us any sign to buy it at the moment. It's just trending below these declining moving averages. I'd stay away from it, Rog. Maybe this is going to be the final low, but why should this be the final low and not November last year, or not April last year, or not March, or not December, and so on and so on? Nothing special about this. other than maybe some fundamental story you can build. But I'm sure the fundamental guys built a story at these previous points too, or some people probably did. So I'd just leave it alone. I'm not interested in trying to get the low. I make my money by buying when stocks are above the averages and trending up, not trying to pick the a final low and getting in on the basement. I'm happy to get on level 3 and take it up to the top floor, not get in at the basement and get that extra couple of floors. But I think you take much more risks that the basement is lower than you think.
Yeah. All right. Now, I apologise to everyone who's got some tickers up there and having to cut this short. It's just I have to be at 1 o'clock. I have to be somewhere else. So for the first time ever, I'm having to cut this short. So once again, we are going to get some great questions in that share for next week. All right. So I'm going to record some of these questions, general ones as well. Obviously, if you want to come back with your tickers, same tickers next week, we will go through them. But don't forget, as always, like and subscribe down the bottom. Go and check out Jason at Motion Trader. And if you want to check me or if you want to say hello at Selfwealth, obviously just send an email to support at Selfwealth and just attention to me. I'm happy to answer any questions, obviously. Thank you for your time, everyone, this week. Thanks, Jason. Thanks heaps.
Roger, that's been fun. Thanks, everyone, for joining us. Look forward to next week.
Thanks, everyone, and we'll see you